Well, I have been pretty adamant about not shorting the market. However, I keep getting questions of, okay, we get it. You don't want to short the market, but if you did, how would you do it? So I'm going to present you with a number of ways that you can take a short position on the market. Now, while I don't short the market, I will short particular names. And Beyond Meat is one that I have put a short on today using options, using August options. They had earnings. Earnings were great. And a bunch of ratings came out after earnings. And I tended to agree with some of the ratings. I looked at Beyond Meat last August when it was about 180 a share. And I was going to do a series for it, for the applied market series on my site. I just didn't have the time. But the leaning that I had at the time that I was doing it was this was a screaming short. It was one product. And a product is not a company. It's simply just a product. And you're going to see a lot of copycats follow on very quickly. And which is what you're seeing. There's no need to buy the company. You could just copy what the company is doing at this point. I don't know that they have longevity as a single product company. I know that they're trying to introduce multiple different product lines, but at the heart of it, they're still just one company. I don't think they're going to go away. I just don't think that they should be trading at the valuations that they're trading at. If you look at their last earnings report, revenue straight up, but cost of sales straight up, cash flow from operations straight down. So that's unsustainable without having to either raise more debt or sell more equity at some point. So I think at 120, 125, I think it's a short. I'm not going to short the stock directly. I like a lot of leeway in my short position so that if I'm wrong, I can see it coming from a long time away. So what I did was I sold two $165 calls for August, and I bought one $120 put, being that I put this on when Beyond Meat was at 125. It's very close to an at-the-money put, financed with two out-of-the-money calls. Since the premiums on the calls are so much bigger than the premiums on the put, I was able to go $40 above the current price to 165 strike, which I feel fairly comfortable that I'm not going to see it go above 165. And if I do, I'm going to see it a long ways off. I'll be able to risk manage that quite successfully. So I'll show you how I put that trade on. If you want to see it actually done on the system. Market's closed right now, but I have the frozen prices in place. I'll show you how to choose your legs for the S&P 500. And again, I don't short the S&P 500. I will short particular names if I want to short something, but to short the market as a whole, I'm not a big fan of that. But if you do want to, there are several ways that you can do it, all with decreasing levels of risk. The riskiest way, I think, is just to short SPY, the ETF, or short ES, which is a futures contract. It's the S&P 500 mini contract. It's for 50 times the index. The SPY, one share of stock, is 1/10 the index. So if you short 500 shares, it is the same as shorting one futures contract. You'll make the same dollar amount. Very, very, very close, like, rounding errors on each one. I prefer, if I'm going to do something, I prefer to work with the ETF as opposed to the futures contract, because the futures contract is big and bulky. I can't finesse very well with that futures contract, even though I can trade for more time than I can with the SPY. The options do become illiquid in the middle of the night, which means that if you're trading with the options, doesn't really matter anyways. It's illiquid. You may as well just wait till the morning. So you can short the SPY directly or sell a futures contract. Shorting the SPY gives you the luxury of time. If it moves against you, you can wait. ES has an expiration date, so if you're negative at the expiration date and you think that you just need more time, you have to roll those contracts over. That might be an easier way out, because once you close one, you might not be willing to open the other one and just take your losses, whereas since you have the luxury of time with SPY, that may be the danger of time as well. As it moves against you, you keep thinking, well, I'll wait, and it just keeps moving against you. That's why I don't like short positions on the market itself. You can use options and create a synthetic short. You can sell a call and buy a put at the same strike price. That should get you a $0 position if you're getting very close to an at-the-money strike. You can do that with SPY or ES. For SPY, I recommend using the September options. If you're going to use a synthetic short on ES, make sure you look at the September futures contract on ES, and don't look at the current futures price and use September options. You got to line it up with the September's futures price and use those options for that particular price, which I think is about 10 points lower on the September contract than it is now. You can use a risk reversal. We've seen a risk reversal. Just take your synthetic short, sell an, instead of at-the-money calls and puts, you're going to sell an out-of-the-money call, and you're going to buy an out-of-the-money put, and you're going to engineer it for $0 as well. So if you're looking at your payoff chart on that one, let me put it in a better position. Your payoff chart on that one, it'll look like this. So there'll be a period in here where if the price ends in between the two strikes, you neither make nor lose money. You'll make money if it gets below the lower strike, and you'll lose money if it goes above the higher strike. That's a risk reversal. You can do it on the futures contract or on the SPYs. Again, I prefer using the SPY for this, only because if it is called away from me, if I do something like this and it is called, I end up with a short position that doesn't expire. I may then take that short position and use options against that short position to hedge out any risk and maybe recover some loss. Again, all risk management stuff that I can do with something that doesn't expire versus something that does expire. And you know I can roll the futures contracts over, but it just seems like you're chasing something on purpose. It just, I just feel better with the ETF. You can also use a combo, and I prefer to use a combo if I am going to do a short position. I prefer a combo. That's what this is over here. The reason I prefer the combo is you can then move your put up to an at-the-money put, as opposed to getting an buying an out-of-the-money put. You're buying an at-the-money put. However, you're selling two out-of-the-money calls, so you can go a little bit higher and give yourself more room on the upside because you're selling two calls to finance one put. You're moving your put up to where the market happens to be, so that the market doesn't have to fall a whole bunch of ways just to hit your lower strike before you start making intrinsic value. You can start with intrinsic value right away. You're going to have a much higher delta, and as it's moving down, that delta will increase. As it's moving up, the delta of the put will decrease, but the deltas of the calls will increase. That can get a little uncomfortable. I'm going to show you on SPY how you can get a really nice margin right now. The value of the puts are inflated, that if you were going to do a short position using the ETF, I'll show you what I think would be a low risk of losing on the calls. It doesn't mean that you can't. It just I'm comfortable with the strike price to the point where if SPY went up an unreasonable amount at this point, another 100 points, I might even think about it. Yeah, you heard that. I might even think about it. Let's look at Beyond Meat right now, and we'll build that position. So here's a news feed from Beyond Meat, and we can see right in here, after earnings were announced, we can see a lot of the calls on it. Bernstein, market perform a target of 118. Beyond Meat, I think, closed yesterday after earnings at 128, 129. Opened today around 125, and I think sold off to about 121. Bernstein, Jefferies, hold target of 95. UBS, a sell target of 75. Goldman Sachs, coverage sell target of 42. You have Bank of America or B of A Securities, underperform target of 68. I tend to agree with those sub-$100 prices. I think it's somewhere around $70, 40 to 70, somewhere in there. I think if you were thinking about a longer term outlook on it, as opposed to just being really excited about the news today that, wow, there's going to be no meat, nobody wants to eat meat anymore because of the virus, nobody trusts animals, this is a safe way. I think that's all going to fade away. And if it doesn't fade away, and there is some holding power to that, all the other food manufacturers are going to have their own version of this anyways. This is one that was early to the party. Maybe it's first, but it certainly won't be the best, I think. I think it's easily replicated at this point. So I do think that this is a short. So I use the August options for that. So let's have a look at the options chain. So here we are with Beyond Meat. I've got the August 20, that's 106 days away. I've got the options chain up. And, you know, the usual disclaimers here. I'm comfortable doing this. I'm comfortable doing this. This may not be something you want to do. You really have to have your own opinion on this. You can disagree with me. You can think that this is the next best thing. And you would disagree with my short position. That is fine. For every buyer, there's a seller. The market is 50-50 at all times. When I put this position on, somebody's giving it to me, which means somebody doesn't believe what I believe in. I'm comfortable with this, and I'm comfortable with the level of risk. If I lose, I'm comfortable losing. All right, so just, you know, I want to put that out there. I'm showing you an interesting way to put on a short. I'm not necessarily recommending that you all do this. For this one here, I wanted a put as very close to the market as possible. I didn't want to go down to a $100 put and finance it with a $180 call. I wanted to get the put as close to the market price as I could. So what I did was I took a $120 put, and all I have to do is up here on Strategy Builder, click here. I can take the $120 put, and I wanted to buy the put. I can see that it has a price of 20 bucks. So I know I can divide that by 2. That's $10 if I divide it by 2, and all I have to do is go up in the options chain till I find $10, and there's a $10 right here. There's a $9.35 and a 10. So I can sell, let's say, 2 of the 935s here. Let's get it here at 2. And when I did it earlier today, it was a credit spread of, a spread in my favor of 50 cents. So I got 50 cents a share by putting this on. And I'm buying a $120 put, and I'm selling 2 $160 calls. When I did it, I had the 165s. The price fell. So to get that same cost, I had to walk it down. You can see here I'm walking it down to 160. It looks like some of the premium has come out of the call options today, which I think is right. I did it early this morning. So there is a short position on Beyond Meat using options that expire in August. This position, or you should, when you put these on, you should organize it such that you don't have to pay anything, and sometimes you get paid yourself, but you're really trying to get to a zero price. You don't want to put money out. So you have a situation where it doesn't work out. It didn't go below 120, but it didn't go above 165. It cost me nothing to do. I don't make anything. I don't lose anything. That's a nice place to be. It would have to get all the way up to 165 before I start losing on this one. I don't quite see that kind of height. Given the amount of negativity by some big analyst names on this one, some big firms, I think they're probably sellers long before it got to the 165. And if it gets below 120, since the strike price is very close to where the stock price is, I'm going to make some nice delta as it starts dropping. I'm looking at hopefully 20 to 30 on the downside, so somewhere sub 100, 100 to 90. I think by August that would be my target for when I would close the position. I only did 3. I only did 3 contracts because it's double the calls, right? That means I'm short 600 shares at 165 and higher. It's a high volatility stock. I don't want to be anything more than that, so I'm good with that. Let me show you SPY. Let's head over there. Here we are, and let's get the right date. We're September on the SPY, and if we look at the SPY price right now, it is 288.45. So let's find a 288 strike. We want to sell an at the money strike. Here we are. Let me just cancel these out here and do it again. So take the 288, and we're going to buy the put. Now notice the put is $20.98. So that means we're going to hop over to the call side, and we're going to scroll up until we see 1050. So you can keep scrolling up, and we have 1048, 1065 right here at the 304. So we're going to sell a call, and we want 2 of these calls to finance that. And notice we have negative 27 cents in here, which means we would get 27 cents per share. times 100 shares. So we would get $27 for each contract that we put in place. Each contract is for 100 shares. So if you wanted to be short 500 shares, you would do 5 contracts of this. That means you will be selling 10 calls. That means if the index does get above 304, well, SPY at 304 is the index at 3040. So if SPY does get above 3040, you're basically short the equivalent of 1,000 shares with 5 contracts on this one. So if you were going to short the market, I would say give yourself plenty of upside, where if you're wrong, you've got plenty of upside to be wrong before it starts to hurt. And because you've got plenty of upside to be wrong before it starts to hurt, you can start risk management before that, which means you can delta hedge out some by buying some of the underlying ETF. So if it starts to get uncomfortable, you can buy 200 shares. If it's a strong day and you feel, well, you know what, we're not going to pull back today, I think we're going to go higher today, you can delta hedge out by buying 200 or 300 shares of the underlying for the day. You can risk manage at that point as opposed to just suffering and losing it. If it does pull back on you, you have an at-the-money put. So your delta is going to be quite high right away, which means you'll start earning on any little pullback, you'll start earning right away. Those puts will start to increase, and because the market is dropping, volatility increases as well, so that put should increase at a faster rate. And your calls, because you're getting lower and lower, further and further from the calls, your calls will start to shrink as well. You're short the calls, so shrinking calls are good. You're long the put, so expanding put is good, so you win on both legs. If it goes the other way, you lose on both legs. But volatility does increase on the way up, which means the puts will tend to, the puts and calls will tend to drop in value as you're increasing. And as you're moving away, of course, the put decreases, the calls will increase because you're short, but the volatility will help offset that. You know, it's sort of a convex payoff. It doesn't hurt as much on the upside as it benefits you on the downside. If you are going to short the market, I strongly recommend using this type of short position, using a combo, and go light. There's no point in being a hero here. Go light. Your job is to get on base. It's not to hit a home run. You're not looking for lottery tickets. You're looking to earn an income. So do 1, maybe 2 contracts, something you're comfortable with. If you're going to do it, you don't have to bet the whole farm. If you're hedging some beta in your portfolio already, it helps to know what your dollar beta is, which means take the beta of your stock and multiply it by the market value of your stock and add that up for your whole portfolio, determine what your dollar beta is and where you want it to get to, and then you can use these options to adjust the value of dollar beta you have. If you don't want to lighten as the market goes up, if you don't want to lighten up but you just want to hedge, you could put on a combo like this and reduce that beta. Yeah, your calls will lose on the way up, but the market would have to get above 3,040 before you start to lose, really start to lose, but your long positions will have worked quite well by then. I'm of the belief that if you feel the market is toppy, it's always better to reduce your long positions than it is to actually short the market. By reducing your long positions, it's the same as shorting because you are selling. And if the market does pull back, you can re-add to those long positions. That's the same thing as shorting and buying at a lower price. You're selling at a higher price, buying at a lower price. Nothing wrong with that. Okay, I hope that helps you out.